Okay, so good morning, everyone. Happy Tuesday. Hope everyone is doing well. Sometimes this season of allergies and all of that, changing weather and all of that. But I'm glad. Thank you for being here this morning. I'm Sophia Bahana, and I'm the project manager of the Minority Business Development Agency. And we're happy to be here serving and assisting small businesses. And one of the way we do that is putting together these kind of workshops in different professional services. In this case, we'll be talking about accounting and fringe employee versus contractor, fringe benefits, and all of those great topics that we all can learn about it. So I'm happy to introduce our guest today is Teddy Decker. So thank you, Teddy, for being here, and just take it away.
Okay, great. Welcome, everybody. I hope you guys get a lot out of this presentation. I've been a CPA for almost 30 years in New Mexico and been helping small businesses. So hopefully I have some good information to share with you. If you have questions, Sophia, can they just ask questions as we go along? Is that all right with you?
Yes, of course. Yeah, they can use the chat or the Q&A.
Yeah. Okay, sounds good. So yeah, either use the chat or the Q&A. We'll keep an eye on those and try to get some questions answered, make sure we do all of that. So I'm going to share my screen so you can see the information. Today we're going to be talking about employee benefits. First of all, we're going to start with contractor versus employee. How do you know what type of person to hire? What can you do, and what are the options? And then we're going to talk a little bit about fringe benefits, and then we're going to talk also a little bit at the end about some of the employment tax credits that are available in New Mexico. There's some really good programs available. So let's get things started. Okay, so here's our information. My firm is called Double Decker Consulting, and this is part of our best practices series. I have to do a legal disclaimer as a CPA, just to let you know that I am not an attorney and I do not give legal advice. We let the attorneys stick to that stuff. Sometimes there's some crossover and gray area between accounting and legal, and so we always just like to give that disclaimer. So you've got a company and you are growing and you need some help and you want to start paying somebody else to help you. You've got more work than you can handle yourself. So how do we go about doing that? The first thing to do is talk about employees versus independent contractors. So there's a lot of confusion and a lot of people throw around the term employee when what they're actually talking about is a contractor. Technically, in a legal sense, an employee is somebody that you have hired, that you pay, and they will receive a W-2 at the end of the year. They have withholding from their pay, and you have control over their actions. An independent contractor is hopefully a lot of times another company that you hire to assist you with your work. We are hired as independent contractors for a lot of people because they don't necessarily need a full-time employee to do accounting, but they might want some help, so they can hire another business. I do this for a whole bunch of different people, and I have my own specialty, my own expertise in doing that. Sometimes you will hire like day labor, which could be an independent contractor. You might have a little more control over their actions and supervision. However, they could still be an independent contractor, but there are some other things that will be classified. If you already have some employees, it's important to not just go along with however they are now. After you get the information from this webinar, hopefully you can go back and reevaluate and say, are my workers properly classified? And do we have all the paperwork in place that we need to in order to support those decisions? So our independent contractors are very specifically identified and defined by the IRS. They are generally people who have maybe some expertise that you don't necessarily have, or are able to work very independently. They should be setting their own schedule. Most of the time, they will be providing their own tools. So if you are providing them all of their tools and giving them all of their schedules, then they most likely should actually be an employee, not a contractor. If they also do this work for other companies and they have their own business set up, then even if it's not expertise that you don't have, they might still be able to be a contractor. In general, administrative help should not be classified as independent contractors. Because administrative help, like if you just hire somebody to come in and answer phones for you, make appointments and things like that, that's going to be generally considered a very high degree of control over that individual, and that relationship is generally very difficult to be considered an independent contractor, unless this is a caveat. Nowadays, they have the virtual assistants. And so if you've hired a virtual assistant, you may have them be able to help you with administrative help on a contract basis. But that person would very clearly have their own business and probably be a virtual assistant for other people in addition to you. Contractors, if you pay an independent contractor $600 or more, so greater than $599, and this is cumulative payments. This isn't just one-time payments. You can't just repeatedly pay your contractors $599 and then not send them a 1099. So this is a cumulative payment for the year of greater than $600 or greater than $599, 600 or more. Then you would have to send them a 1099. At a minimum, we recommend that you ask all of your contractors for a W-9. Sorry, yes, a W-9. So W-9s you get from your contractors, and they will include on there their tax ID numbers, and they will tell you what their legal classification, what their business classification is. If they are a corporation or an S corporation, then you do not have to send them a 1099. You should still ask for the W-9 at the beginning of your relationship to show that you checked on this. The exception to that is if the company has Inc. or Co. in the name of their business, then it's okay to assume that they are legally a corporation and you don't have to get a W-9 from them. If they have LLC in the name of their business, then you may still have to send them a 1099. And so those are the ones that it's really important to ask for that W-9 and double check it to show that you have it in your records. If you get audited by the Department of Labor, and you can show that you have the W-9s on file, and somebody said they represented that they were, their name is an LLC or it's just their individual name, but that they marked on the W-9 that they are an S Corp, they're taxed as an S corporation, then you don't have to send them a W-9, a 1099 at the end of the year, and you've got your liability protection because you did your due diligence to check on that. So when you have a contractor, as I was saying, do they pass the smell test? So the smell test, you want to get that W-9 to be sure what kind of individual they are. Hopefully they are a business themselves where they're set up to pay their own gross receipts taxes in New Mexico. They're set up with their own insurance, and you can ask for proof of insurance. If you're hiring individuals that are not set up with their own insurance and as a business, then expect that you probably will have to cover them under your workers' comp policy, even if you're paying them as independent contractors. So here's some more details that talk about what IRS tests the IRS is going to look at. If you get audited by the Department of Labor and they come in to see, or should these people be employees or should they be contractors? If you have them set up as contractors, you should check these items to make sure that they pass the IRS tests. Do you have behavioral control over the worker? So if you have the right to direct them and tell them what time to be there, how long they have to be there, exactly what they're doing, do you have the tools? Are you providing the tools? Are you training them? Those are all behavioral control issues. And if you have complete control over that individual, then they're likely an employee and not a contractor. If you give them a job and say, here, go do it, and you just tell them, I need it done by such and such a date, then that's perfectly fine. And that would be considered a contractor situation. And do you have financial control over it? Are you telling them how much they're going to make? Or do they tell you, this is what I bill for? Do they give you an invoice? Do they, or are they just giving you a time card? It might be a negotiation where you guys have a discussion, but if you have complete financial control over how much they make, they're probably an employee. And then you also should have a written contract, whether they're an employee or a contractor. You want to make sure that you actually have a written contract that defines the relationship, that tells, is this a contractor situation or is this an employee situation? Who has the control? Who's responsible for paying the taxes? Who's responsible for bringing tools to the job? All of that kind of stuff. You want to really evaluate all of those whenever you're looking to hire employees. For the 1099, so here's a little sample of what the W-9 looks like. And this is the important information in here where it's highlighted yellow. All of your independent contractors, you should ask them for the W-9 at the beginning. I generally recommend best practice is to get the W-9 before you pay them. So it's amazing how much faster they're willing to give you a W-9 if their check is waiting on it. And you can just make a company policy. We do not pay our contractors until we have a W-9 on file. That's how all of the big companies do it. If you work for City of Albuquerque or anybody else, they're going to require that you give them a W-9 before you get paid. And then they can ensure that they get those on file. Now, just because they gave you a W-9 does not mean you have to give them a 1099 at the end of the year, but you at least need to have the W-9 on file. And then you would give the 1099s at the end of the year to contractors that make $600 or more that are not C Corps or S Corps. Okay. And the 1099s are, we now have we have a couple different 1099s. They used to get filed on a 1099 miscellaneous, MISC. Nowadays, contractor payments are filed on a 1099 NEC, which stands for non-employee compensation. And those have to be filed with the vendor and the IRS by January 31st. Of the year after for the year. So for 2024, 1099s will have to be filed with the IRS and the vendor no later than January 31st, 2025. Okay, so when you're making payments, you want to make sure you keep track of all payments paid to the contractors so that you can have that information to file those 1099s at the end of the year, not to mention for filing on your income tax returns, and also just for knowing how much you're spending. You want to make sure that you have a written contract in place that includes all of the tax ID numbers. And the contractors would be responsible for keeping track of their own expenses. So if they provide supplies or all of that kind of stuff, they are responsible for keeping track of all of those expenses. You can reimburse them for expenses if you have agreed upon it ahead of time. But those payments still go on the 1099s as the total that was paid to them. And then the contractor is responsible for taking those as expenses on their tax returns. And then insurance, which we touched on briefly already. Hopefully they have their own insurance, but you can cover them under your workers' comp insurance if you determine that's part of the agreement. For an employee, this is now you have control over the person. And these are some, if you're going to have actual employees, then you want to have a few policies in place. You want to make sure that you've got some anti-discrimination, equal opportunity policies. You should have a code of conduct, information security. In this day and age, there's hardly a job out there that doesn't involve a computer. So it's a good idea to have a policy in place to make sure that your employees are all clear on the security that is required and what they are expected to do, how they're expected to behave. Even if you have an information technology insurance policy, they usually require that your employees meet a certain level of standard. And so if there ever is fraud or data breach, then they're going to be investigating to see, okay, well, was it one of your employees that screwed up? Have they had the training that they were supposed to have? Or is there a lack of that information being shared with employees? If you have any benefits provided, you should make sure and have a policy that describes what those are. In New Mexico, all employees are required to be paid a minimum amount of sick leave. And so you want to make sure that you have a policy written up and, you know, not just how much accrues, but how do they use it? How do they request timeout? How much is granted per year? All of it, does it roll over? There's lots of different things to consider around the leave, not just whether they have it or not. And who's eligible for it. If you give vacation time in addition to sick leave, you know, who's eligible for that and how much do they get? So when you hire an employee, so for a contractor, it's usually pretty easy. You usually just ask for the W-9, and if they have their own insurance, you might ask for proof of insurance. Those are the only two things that you really need if you are doing a contractor situation. With an employee, there's a lot more documentation and information that's required to get them set up. So the W-4 is the form that is used for an employee that lets you know how much they want to have withheld from their paychecks for their federal and state income taxes. The I-9 is a proof of legal ability to work in the United States. And is required to also view a driver's license or a passport or other proof of being able to work in the United States. The state withholding form in New Mexico, we don't have a separate state withholding form. We just piggyback off of the W-4. So if they're in New Mexico, you probably don't have one of those. There are other states that do have state withholding forms. So if you're hiring remote employees that are maybe going to work in a different state, you want to make sure and investigate what the requirements are for that state and see if they have their own state withholding form and getting accounts set up. The direct deposit forms nowadays, most people like to have direct deposit for their payroll. It's usually much easier for both the employer and the employee. A lot less chance of paychecks going missing and having to be rewritten, et cetera, et cetera. And then if you're offering benefits, there might be some benefit enrollment forms that are needed to be completed. And we'll go through some more of the details around the benefits here after a little bit. And then you want to make sure that you're maintaining all of those records in your documents, in your files. They can be electronic. They don't have to be paper documents. But if you're things like the W-4 and the I-9 that had to have a signature on them, you probably want to get a wet signature on paper and then scan those documents in so that they can that you should have them in your records. I also recommend best practices is to keep, if you've got interview notes, if you have copies of resumes, all of the pre-hiring documents, the contract that you and the employee would both sign are good, and you should keep all of that information. This is where you would also keep any annual review notes, if they ever have any warnings or increases in compensation, all of those kind of notes would be kept in their employee files. And then at the end of the relationship, you would want to make sure and keep separation of employment documents. So if the employee leaves of their own volition, then you might have an exit interview with them, and some documentation around the fact that, if they sent you a letter indicating that they were leaving your employment, then that would be maintained in their office, in their employee file. And you should probably hold on to those for 5 to 7 years after they have left your employment. So payment apps, this is talking about nowadays, a lot of contractors will ask to be paid through Venmo or PayPal. If you pay someone and they have a business on Venmo or PayPal, or other cash apps like that, then you do not have to send them a 1099, because those payments will be recorded on a 1099 from the vendor that makes the payment. So Venmo, PayPal, those guys are now sending their own 1099s on those. And if you also send a 1099 for those payments, then the income will be duplicated. Same thing goes if you make payments on credit cards. So if you have a vendor that takes a credit card from you for the payment, you do not have to include those payments in a 1099 payment. But if you pay $600 on a credit card over here, and then the next month you pay $1,200 with check, then you would still need to send them the 1099 for the $1,200, the amount that you paid on a check, and then the $600 that was paid on the credit card will be taken care of on the 1099 from the credit card company. This is only for businesses. So if you have a business, and that can include rental properties, Schedule Cs, doesn't matter what kind of business you have, and you're making those payments, then those would all need to be on the 1099s, or make sure that they're paid through one of the services that will be sending their own 1099s. If you're just making a personal payment, you guys all go out to dinner or you go on vacation together, and then you pay them, your friends, back for what they spent on the vacation, that does not go on a 1099. That's not a business payment, that's a personal payment. Let's talk about some New Mexico employment credits. So what New Mexico has quite a few employment credits that if you hire the correct people, you can actually get a significant portion of their pay reimbursed to you. This helps in a lot of cases with hiring an employee who is maybe a little less experienced. And so you're going to be taking the time and effort to get them trained and get them a valuable skill. And the state recognizes that and wants to help out employers to make sure that we continue to give opportunities to some of these groups of people. There's the New Mexico Work Opportunity Tax Credit. This one is for certain, is a credit that's given for certain populations of the state. So if you hire veterans, TANF recipients, SNAP recipients, certain community residents, vocational rehabilitation referrals, ex-felons, SSI, summer youth employees, long-term unemployment. These are basically people that maybe would be a little bit harder to employ in some cases, like the ex-felons. The designated community residents, that one has to do with where they live. So there are certain areas of the state that have credits associated with them, and if you hire somebody that is a resident of a certain area, then you can get credits. Others are people that are on welfare and other long-term unemployment, other social welfare programs in the state. If you hire them, then you can get credits back. The credits are between $1,200 and $9,600 per employee. They have to work at least 120 hours in the first year of employment. And this is actually a federally administered. And so there are federal forms that have to be filled out for these that are available here. You can see the form numbers. These credits, one important thing is you often have to fill out these forms and get them turned in either before the person begins their employment or within the first like 30 days. There are some very tight time limits on the work opportunity tax credit. So if you are thinking about hiring or you interview and you find somebody who's in one of these categories that would be a good employee for you, then it's important to make sure that you get your paperwork filled out ahead of time, because if you don't, you can just lose those credits. We also have in New Mexico high wage jobs credit. If you have a more specialized job, that's going to pay $60,000 or more in or near a population of 60,000 or more. So that would be in Albuquerque, and this is within 10 miles of Albuquerque, Santa Fe, Los Alamos, Las Cruces. The bigger cities in Albuquerque, it has to be $60,000 or more. If it's a more rural outside of one of the major population centers, then the pay only needs to be $40,000 or more. And if you're going to make those payments, then you can get a credit of $12,750 back per employee. There's a New Mexico form to fill out for that. And as of right now, this program is set to sunset July 1st, 2026. So that is coming up fairly soon. I don't know, it remains to be seen if it will be extended or not. But for right now, that's where it is. So if you're thinking of hiring somebody that's a little more skilled and gonna pay them a decent salary, then you might look into those credits. Also, if you were thinking of hiring somebody at like 55,000, you might consider increasing it. You know, this could affect like how much you wanted to pay them. If you can get, at least in the first year, you can get a credit back that would more than offset the additional pay to them. So we also have job mentorship program. This is for youths between the ages of 14 and 21 that are attending an accredited New Mexico secondary school full-time. And this one will pay up to 50% of their wages on the first 320 hours of employment. There again, there's some forms to fill out with the state of New Mexico. And this is meant to help get our youths educated and some valuable skills to get good work. And then here's there are three other credits available. Rural jobs credit. This is if you're outside of the major population areas and you're going to hire some employees, you might be able to qualify for that one. It's based strictly on location of where the job is, not where the employee is. The technology jobs credit, that one is if you hire somebody in a technology position, then you might qualify for that one. The employee needs to be in New Mexico to qualify for that one. So a remote employee that's out of state wouldn't necessarily qualify for that one. And then the welfare to work credit, this one is administered. So all of these, except for, so the first New Mexico the workers work opportunity tax credit, this is a federal program. All the rest of these are administered through New Mexico Taxation and Revenue, except for the welfare to work credit. And this one is administered through the New Mexico Department of Workforce Solutions. The welfare to work credit also requires certification through the Department of Workforce Solutions before you hire the employee. So you want to make sure that the company that your company gets set up with Department of Workforce Solutions before you hire the employee, so that you can make sure that you get the correct people hired and would actually be available. I think that's it on the contractor versus employee section. Let's take a little break and see if we've got any questions. Anybody have a question? Doesn't look like we have any questions out there at the moment. So we will go right into our company fringe benefits discussion. Okay, so let's talk about fringe benefits. So you've got some employees now. You decided you have control over them, and you have some employees. What benefits are you required to provide? The answer to that is pretty easy. In New Mexico, the only benefit that you are required to provide if you're a small employer, so this is assuming you have 50 employees or less, I think most everybody is on these webinars is starting things out, and so would be looking at hiring their first employee or two, and they're not looking at hiring 100 or more employees all at once. So in New Mexico, the only required benefit that you have to provide when you're a small employer is the paid sick leave. New Mexico enacted that, I want to say about a year and a half ago. The minimum amount of paid sick leave that you were required to give is 1 hour of sick leave earned for every 30 hours that your employee works. You can grant sick leave all at once at the beginning of the year in a bank, or you can have it accrued based on the number of hours that they work. Beyond that, any other benefits that you might provide are strictly your choice. You can provide other benefits, but you're not required to. So probably the most typical benefit that you hear about the most would be health insurance. So health insurance can be provided for your employees. It can be entirely paid for by the company, or more often than not, the premiums are paid for partially by the employee up to a certain amount that you agree on ahead of time. And then the rest of it is deducted from your employee's paycheck if you're going to provide health insurance. If you are an S corporation or an owner and you want to have health insurance for the owners of the company, but not provide health insurance for your employees, then you are allowed to do that. But it shouldn't be a company plan then. Instead, it would be an individual plan that the owners have, and you can reimburse the owners for those premiums on the S corporation, from the S corporation, or the LLC, or however you want to do it, but they're paid for. Those benefits are the S corp owners and business owners are the only people that you are allowed to reimburse for individual health insurance premiums on their plans. Obamacare made it illegal for you to reimburse other employees for their healthcare premiums and have it be a pre-tax benefit. So if you want to, if your employee has their own health insurance plan and you want to reimburse them for the premiums, the only way you can do that is basically by paying them more than you would have otherwise. So, but it's just regular W-2 wages. Essentially, you pay them, another $500 or however much you agree on their W-2 wages, and they can take that money and do whatever they want with it, whether they use it to pay for their health insurance premiums or do something else with it. That's up to them. But you aren't specifically allowed to write them a check as a reimbursement for an individual health insurance plan. If you decide to do a group plan, then it generally has to have more than one employee. So it might be the owners plus an employee or two, however many you have. Excuse me. Just make sure that you have the proper group plan set up and that you're doing non-discrimination for each of your employees. If you offer health insurance coverage to one employee, you need to offer it to all of the employees that have the same classification as an employee. So you don't have to offer it to the same coverage to part-time employees as you do to full-time employees, but all of your full-time employees should be offered the same benefits. And then as far as paying for the premiums, if it's a group plan, you can pay for it directly. If it's an individual plan and you have no employees, then it's fine for the S Corp or the corporation to pay the premiums directly. If you are a more than 2% shareholder of an S Corp and the company is paying for your health insurance, then it has to go on your W-2. It has to be included in your Social Security wages. So it's important that you talk to your payroll administrator and make sure that they know that the health insurance premiums are being paid, and make sure that that gets included on their paycheck. If you are an LLC, not an S corp, you're an LLC partnership or a regular corporation, then that would just be considered a pre-tax benefit, and it doesn't have to go on the W-2. If it is perfectly fine to offer health insurance premiums paid for the owners of the company and not pay for health insurance for your other employees. Unless you have a group plan, that on the group plan, as I mentioned before, if you offer health insurance to one employee, you need to make sure that you offer the same benefit options for all of your employees of the same classification. You can also provide other insurance options, long-term care, disability insurance, life insurance. Those are all fairly common. Life insurance is a fairly common benefit that you can offer to employees, often for not too much cost. If you have life insurance on owners of the company, make sure that you talk to your tax professional about whether or not you want to deduct the life insurance premiums from as an income tax deduction on your tax return or not. In certain situations, it's actually a better idea not to deduct those premiums, just take those. You can still pay for it from the company, which is perfectly fine. You just don't necessarily want to take it as a deduction off your tax return. Disability and long-term care insurance premiums are typically pre-tax benefits for both the company owners as well as for employees, if you feel like offering those. There are also policies out there where you can offer this to your employees, but they would pay for it themselves. So they would pay you just have it set up and they can sign up if they want it. It's purely an opt-in situation so that they can choose whether they want it or not, and then the premiums for it would be deducted from their paychecks. Health savings accounts. So in conjunction with health insurance, we have health savings accounts. There's a lot of employers that will set up, especially nowadays with health insurance being so expensive. If you have a high deductible plan, health insurance plan, then you might want to set up a health savings account. And a health savings account, or HSA, works kind of like almost an additional IRA account, except that you have the caveat that you are allowed to take money out of the HSA account and use it for health insurance. So this is a really good way to get your health costs paid for with pre-tax dollars. Most people nowadays, especially, don't have nearly enough out-of-pocket medical costs to be able to deduct them on their income tax return. And so this is a way to shelter some money and pay for any out-of-pocket medical expenses using pre-tax dollars. The way that an HSA works is the employer, the company would put money into an account on behalf of an employee, and then and this can be for the owners as well. And then when medical costs are incurred, they either submit an invoice or an EOB to show what they had to pay out of pocket, so they would pay for it up front, and then the HSA account would reimburse the employee for those medical costs. The other way that it can work is some HSA accounts either have a checkbook or a debit card, where when you need to pay for qualified medical expenses, you just pay for it directly out of the HSA account using the debit card or the checkbook. This is a great way to help keep some of the health insurance costs down a little bit, because you typically are required to have a very high deductible on your health insurance premium. So back in the day, we used to call it major medical. So you might have an insurance plan that doesn't necessarily cover all the day-to-day stuff, but would kick in if there was a major emergency, like a hospitalization or a surgery or something like that. So the health insurance would be there for that, but then all the day-to-day stuff, just the, urgent care visit or annual checkup or whatever, would be paid for out of the HSA accounts to cover that. So for 2024, the HSA limits, you have an individual plan, you can put $4,150 into this. And then you have max out of pocket of $8,050, which has to do with the insurance policy. You want to make sure that that's covered. You can add another extra $1,000 if you're aged 55 or over. Or if the covered person is. And then if you have a family plan, you can put in $8,300 max with $16,100 max out of pocket. And that's the insurance coverage. So your high deductible plan would show $16,100 max out of pocket to be covered, to be able to be in conjunction with your health savings account. The 2025, you can see the limits go up a little bit on there. Typically you can open a health savings account at any bank. Most of our credit unions and our banks will be able to open them. All of the major investment houses, Vanguard, Fidelity, Charles Schwab, any of those guys would also be able to open HSA accounts for you as well. And so you can just go talk to the bank about getting an account set up, and then have the company fund the amount for the year. And the dollar amount for the year can be contributed at any time. So it's not too late to start an HSA for 2024 if you have the correct health insurance that goes with it. One thing to make sure of is to double check to make sure that you have the high deductible insurance policy that allows for the HSA, and that they're not stepping on each other's toes. If you take a distribution out of the HSA account, so you don't have to spend it every year, any amount that you don't spend in a year just rolls over to the next year. And continues to accrue. I mentioned at the beginning of this discussion that it's kind of like an IRA, in that you can continue to accrue money in this account, and after you're retired, you can continue to use this to pay for health insurance costs. But over the age of 65, you can also just take the money out of the account, just like any other traditional IRA. You'll pay ordinary income taxes on the money when you take it out, if you take it out for non-health costs, but you wouldn't have to pay any penalty unless you take money out of it when you're under 65. And as you get older, you can continue to use it for medical expenses, and then it would still remain tax-free. You still don't have to pay tax on those dollars when you take them out, as long as it is used for qualified medical expenses. Also, qualified medical expenses can also be the cost of health insurance premiums. So it's a little ironic, but you can use the, $8,300 family plan. If you're self-employed, you're probably paying at least that much for family coverage on your health insurance in a year. And then you get your health insurance premiums pre-tax. So ways to get started on an HSA: verify that your insurance plan allows it. And then just go to open an HSA at your bank. and pay for those qualified medical expenses. It's as easy as that. So no other hoops that you have to jump through or anything like that to get those accounts set up. Let's talk about retirement plans. So it's all very important to start planning for retirement. As a self-employed individual, retirement contributions are probably one of the best things that you can do for yourself for income tax savings. The retirement plans are my favorite way to have the company spend money on you in order to get tax savings. We as a business owner, we're always looking for ways to help save on taxes. But I always say that it's never a good idea to go spend $1 over there on somebody else to save yourself 25 cents. You're better off just paying the 25 cents in taxes and keeping the 75 cents for yourself. Except in the case of retirement, because you're paying yourself in order to save those tax dollars. There are a number of different retirement vehicles that can be used when you're self-employed, and they all have different qualifications, different amounts of hoops that you have to jump through in order to get them set up and running. And so here are a number of them, and we can go through and talk about some of the different options there. So we have the simple IRA. With the simple IRA, it's these all are acronyms that stand for different things. But a simple IRA is a plan that is used for employers that maybe have employees. It's easier to administer than a 401k, and takes less hoops to jump through. There's a form that you fill out at the beginning, and your options with the simple IRA, your employees can contribute, or you can contribute for yourself if you're the business owner. And then there's also an employer matching portion for qualified employees. So the employer matching portion, you have the choice as the employer whether you want to put in 2% of everybody's salary, whether they contribute or not, or 3% as a matching contribution. So the matching contribution would only be for employees that make a contribution themselves. And then the other one would be a non-matching contribution, where the employer just says, we want to give 2% to everybody, regardless of whether they put anything in or not. With the simple IRA, you can set it up through one of the brokerage houses. Sometimes employees will have their own account that they set up. And sometimes the employer will have all of the investment accounts set up in one place. It's usually easier if you have all of the all of the accounts set up in one place, because then you only have to make contributions to one place after each payroll, instead of having to send it to each of the employees' different brokerage houses or whatever. With a Roth IRA, so I'm going to talk about IRA and the Roth IRA together. Both of these ones would only be used for business owners. And this is just the standard contribution that can be made each year. For 2024, the IRA contribution amount is $7,500, and you can put in an additional amount if you're over 50. I believe it's $1,000 additional, With a Roth IRA, the money goes into the IRA after tax. So you pay tax on the dollars today, but then the account grows tax-free. And when you take the money out in the future, you don't pay tax on it. So if you're young and you're not necessarily making a ton of money right now, the Roth IRA is definitely going to be a really good option for you, because you're going to be better off paying the tax today. You're probably in a lower tax bracket anyway. And then it can grow for a whole lot of years without you having, and then when you take it out later on, you don't have to pay tax on it. With a traditional IRA, the money, you don't pay tax on the money today, but later after you retire, then you pay tax on it when you start drawing money out of that account. So if this one, if you have a very high income now on your business, maybe you're self-employed and you're earning a whole bunch, then it might be a good idea to put money into a traditional IRA, because if you're in a higher tax bracket now, then you will be after you retire, then you might not want to pay the taxes today, and you can push it down the road. The SEP account, this stands for a self-employed pension account. The SEP is you are allowed to contribute up to 25% of your self-employment income. So if you're an S Corp, that's going to be your W-2 wages. If you are if you are an S Corp, this is going to be 25% of the amount that you are paid on your paycheck, on your W-2 wages. So you might take distributions out, but you are still only allowed to put 25% of what you pay yourself on a paycheck for the S Corp. If you're an LLC partnership or sole proprietor, then this is going to be 25%, up to 25% of your self-employment earnings. For the SEP, if you have employees, you are required to put that same percentage into the employee plan that you do for your own. And this is for full-time employees. So if you have a SEP and you decide to put 10% of your self-employment earnings into your SEP account, you need to also put that same amount into your employee's SEP account. If you don't want to contribute to your employee's retirement account, then a SEP is probably not a good idea for you. We mostly see the SEP plans with self-employed individuals that have no employees. It's still a nice benefit to give to your employees if you do want to make some contributions there. But just keep that in mind when you're setting up a SEP, or if you're looking at putting some money into retirement. The maximum amount that you can put into a SEP account is right around $70,000. It's a little less than that. I want to say it's 69,000 in 2024. There again, that amount is indexed every year, but you would have to have almost $300,000 worth of self-employment earnings in order to be able to fully max out your SEP, with that being the 25%. We have defined benefit plans. So a defined benefit plan, we don't see these too often anymore. This is what we would normally think of as a pension, especially for a smaller company. This is usually much more difficult to administer. You have to put in a certain amount of dollars, and then the benefit that you are going to get from it after you retire is set up, and is part of the plan. These usually take a third-party administrator to take care of them because the calculations on these are much more complicated and determining exactly how much you have to put into it. So I'm not going to cover the defined benefit plan in too great of detail because they're just not as common nowadays, and not just the complexity and the expense of them make them a little more prohibitive. We have solo 401ks, Roth 401ks, and regular 401ks are all different options. So a solo 401k would be an option only if you are the only employee. If you just want to provide some retirement for yourself and you don't have any other employees working for you, then a solo 401k is a great option. It allows you to put, it's kind of like the SEP or a traditional or Roth IRA, where you can put money into the account. But you get to put a little bit more, so you're not limited to the 25% of the SEP account. You can put up to 100% of your self-employment earnings, up to that maximum of 69,000 that I was mentioning before, and that can go into the solo 401k. The solo 401k does require a little bit more administration to get it set up. So you would usually work with a broker. I believe that Vanguard, Fidelity, Schwab, all those guys, you know, the bigger major brokerage houses all have solo 401ks that you can open accounts. They aren't too expensive to get set up and administer on those. You can you would just check into an account with them and getting that set up, and then normally you would set it up so that you can make ACH transfers and hopefully are making those contributions throughout the year. With a Roth 401k, just like the Roth IRA, money goes into this account pre-tax, and so this has to be post-tax. So money is already paid, you've already paid tax on this. You don't get to take a deduction for it this year, but the 401k gets to grow tax-free, and later down the road, you can take the money out of it tax-free. If you want to set up a benefit for your employees, then you can also just set up a regular 401k plan. And with the 401k plan, there are a few more fees involved with that, and in administering it and getting it set up. You normally would have an account administrator that will make sure that you do the proper testing and contribute the proper amounts, as well as filing a tax return. So a traditional 401k plan has to file its own tax return at the end of the year. It's called a 5500. And make sure that you're doing all the proper reporting to the government and getting the payments paid. The 401k typically allows for employee contributions, an employer matching portion, and then also the potential of employer profit sharing portion. Depending on the way you set up the plan, all of those different contributions can be made, and it can make a nice little benefit for your employees, in addition to getting some money into your own retirement account. So what type of account is best for you? You would want to look to see, we've got non-qualified accounts. So those are the ones we talked about: SEP, simple IRAs, Roth IRAs. These are after-tax contributions, but the SEPs and simple IRA and a traditional IRA, you would just pay in money to those accounts, and then we take a deduction for them when we file your income tax return. Qualified accounts, so these are ones where the employee can make a contribution in addition to the employer. Those are our 401ks. The profit sharing plan, that would be the profit sharing going into the 401k. And then, do you have other employees who are eligible? So you want to make sure that's going to be one of the major considerations of which retirement plan to choose. is if you have other employees and if you want to provide some benefit to them along with yourself or not really. Here, there's a little note about rolling to a Roth. So one consideration is with a Roth IRA, there are income limits. So if your income is high, you may not be eligible to contribute directly into a Roth IRA. However, we can do what's called a backdoor Roth. There are no income limitations if you do a rollover into a Roth IRA. So if your income is too high for the direct contribution into a Roth account, then you can make a contribution into a traditional IRA account and then immediately do a rollover into a Roth IRA account. So the end of the day, this has the same effect as if you made your contribution directly into a Roth IRA, but we've gone through the gyrations that the IRS requires to show that we have done it correctly and not get you into trouble. The IRA contribution would be considered a non-deductible IRA contribution into your traditional IRA, and then we roll it over into the Roth IRA, and then that has the same effect as contributing directly. And that's called a backdoor Roth. You might hear some people talk about that. So here are some examples for you of different types of things that you can do. So if you're funding your retirement, so this assumes that you're being paid $50,000 either on a paycheck. If you're an S Corp, you would have the $50,000 paycheck, draws are separate. Or if you're self-employed, it's an LLC, single member LLC, or a partnership, that you have $50,000 of self-employment earnings. And so if you have a simple IRA or a 401k, you have contribution amounts, the sample based on 50,000 gross wages. We would have the simple IRA, you can do 3% of wages, so $1,200 that you could contribute. And then the employer max for the SEP or the 401k is going to be 25% of wages, or 12,500. So you can see there's a huge difference there if you wanted to contribute more. This is employer contributions, keep in mind, not employee contribution. So with the employee contributions, with the 401k, you can put a max of 23,000 if you're under 50, or 30,500 over 50. So now with a 401k plan, you could put a maximum of 35,500 in if you're under 50, and plus a little bit more if you're over 50, that you're getting put into a retirement account. And that's still paying yourself gross wages of $50,000. And then for the simple IRA, the employee can put a maximum of $16,000, sorry, if you're under 50, or 19,500 if you're over 50. It can't be greater than 100% of self-employment wages. So $50,000, you could put your max of 16,000. So you can see that you would have the option to put a lot more into a 401k than you, or a SEP, than you would with a simple IRA. So the simple is very simple to administer, but you are more limited on how much you can put in into it. You can put in more to the simple IRA than the traditional or a Roth IRA contribution, though, which is only $7,500. So it really depends. You want to balance out how much do you want to put in, how much do you have available to get into your retirement accounts versus the tax savings, versus do we have other employees and all that information. So there's a lot of different moving pieces, a lot of different vehicles available, and depending on your goals, you might choose one plan over another. So this just talks more about what is the tax benefit. You know, we talked about the Roth accounts versus the traditional accounts. Is it a pre-tax or a post-tax? What is your plan for retirement? When are you going to retire? How much do you want to have available? All of that kind of information. For the timing of the funding of these accounts, typically if you have employee withholding on the accounts, then you have to make those payments. The IRS says within a reasonable amount of time. So that's typically considered, you know, within a week or two of the end of the month, you should make all of the contributions from the prior month. For the employer contributions, you don't have to make those contributions until the filing date of the income tax return. So you can save up all year long and then not make the contribution to the employee accounts for the employer portion until you're getting ready to file your income tax returns for the previous year. So you've got quite a while to go on those. Make sure that you are budgeting. So if you're planned to make an employer matching contribution, just make sure you budget for that. You can save it up in those accounts all year long. Just like I mentioned, and you don't have to pay it until later, but if you know that you have a harder time saving up and you're more tempted to spend that money, then it's fine to go ahead and make those matching contributions and the profit sharing contributions all throughout the year to spread out the payments and keep it more within reach and reasonable. So the IRS currently offers a federal retirement plan startup cost tax credit. This is a pretty big deal because if you start up a new retirement plan, this can be a SEP, it can be simple, it can be 401k, any of those plans that I mentioned, and you incur startup costs, then you can get reimbursed, you can get a tax credit on for those startup costs up to 100% of your costs. So especially the plans like a 401k or a defined benefit plan that are more costly to administer, it's going to cost you some money out of pocket to get a plan in place and set up. But when you file your income tax return, you can get a tax credit for that money and get paid back. Not only for the costs of getting the plans set up in the first place, but also a portion of the contribution and matching that you put in for your employees can be reimbursed. So this has to be a new plan that's being set up. So you can't, if you already have a 401k plan in place, you can't close down that 401k and start a new 401k and then takes the credits for it. This has to be a brand new plan that has different employees that are not involved in another plan that was very similar to that. You have to have 100 or fewer employees that are receiving at least $5,000 in compensation per year. And you have to have at least one plan participant who was non-highly compensated. So this means these credits are not available for the solo 401ks. If you're the only employee in your company, then these credits would not apply for you. And then you have not had a similar retirement plan in place in the 3 prior years. When you get your plan all set up, you paying an administrator who's going to do the 5,500 for you and set up the plan and do the testing. And you might pay them, you know, a couple $100 or $1,000 in the first year. And then in the other years, it might be more than that. So you get to claim this credit for 3 years. And then you can claim 100% of the eligible startup costs up to the greater of $500 or the lesser of $250 times the number of non-highly compensated employees. So the non-highly compensated employees are going to be, this is a 401k definition. the highly compensated employees are gonna be basically the business owners, the highest paid employees, in there. And with a 401k plan, they want you to make it available for your other employees who aren't necessarily making as much. And so you need to have at least one participant who is non-highly compensated. And then you can take credits of the actual dollars that you pay on the startup costs, and then as well as a portion of the contributions and the matching on there. Alrighty. Let's go back. So do we have any other questions? It's a very quiet group. There's no Q&A in chat.
Yeah, I don't see any questions, Teddy.
Okay. So I finished way early. I was hoping for some questions on there. Do you want me to cover anything else, Sophia?
No. Well, that was all the topics planned to cover for today. So thank you. That's a lot of information.
There's a lot of information there. Yeah. And Sophia has my contact information. So if people have questions later or just didn't want to ask it during the presentation, I'm happy to provide information. I also have a flyer on the work opportunity tax credit that I mentioned that that I'm happy to forward to Sophia, and she can get it out to anybody. Oh, it looks like
That would be great. Thank you. Erica, you say thank you. And Teddy, if you can send me the slides so I can share with the attendees.
Yes, my pleasure. Yep.
Yeah.
Thank you. Great.
Okay, Teddy. Thank you so much.
Sure. Thank you, everybody, for being here. Appreciate it.
Thank you. Have a great day, everyone.
Okay. Thank you. Bye-bye.
Bye.